I've been trading for nearly 8 years at this point, and fuck it, I'm gonna give away this strategy that has made me north of $3 million. And before we begin, it's important that you understand what I've actually done. Throughout my entire career, I have competed live on stage in the World Crypto Trading Competition. I've traveled the entire world, I've lived in 4 countries, I've just bought my dream house, and what you're about to learn here is exactly what got me into the position that I'm in today. So in this video, you will find absolutely no fluff, okay? And that's exactly why we started off by saying most people will never make it. And that might sound rough, right? But it's the reality. 99% of the people watching this video will never make it. This is probably the face of 99% of you out there watching. What do you mean 99% of us will not make it? I'm sorry, but that's the reality. We're not trying to be like everyone else. What we're trying to achieve here is greatness, right? It is extraordinary and few make it, and that is why it pays. Think about it like this. All the people down here, right? These are the people that downloaded TikTok, saw all the fancy cars, and figured, well, I'm gonna try trading. Then we have the people up here, right? A little bit less than all the people down here. These are the people that actually took some actions, right? They maybe, they went on to Baby Pips, they might have, opened TradingView, etc. And so this list goes on and on and on and on and on and on, and basically one out of all of these people will come out on top. Now, the good part about this is that it is entirely up to you where you place on this ladder. Now, the first thing you learn in this video is exactly how I crafted this system from scratch, because I can almost guarantee that what you're doing right now is entirely wrong, and you're about to find out why. You see, most traders believe, and I'm not an exception of this. This is exactly what I did when I first started. Most traders believe that they should copy and paste someone's system in order to succeed. So this is the path, the natural path of about 99 or 98% of traders. They go on YouTube and they find a profitable trader. First off, right, the first problem with this one is that the guy they find, right, the first YouTuber they find to sort of guide them through their career is most likely not even profitable. And so they're getting, set up for failure from the beginning. But in other words, they find a YouTuber, an influencer, someone to teach them the art of trading, right? The next thing they do is that they learn his system. Why? Because this guy up here, right, he made it seem as if he had made millions of dollars from the strategy that he showed his entire YouTube channel. Now, later in this video, I'll break down exactly why that is literally impossible. But for now, let's keep going, right? So you learn his system and you trade that system on repeat, right? You're obsessed. You want this to work. And so you do it day in and day out. You give it about 1 to 2 weeks of refinement where you actually sit down and analyze, what am I doing wrong? What am I doing right here? And you believe that this is exactly what is going to lead you to profitability. The problem is, if that was the case, this chart here would be flipped, right? All of these guys down here would be on top and there would only be 1 or 2 people at the bottom, and that's just not the case. And so all of this sounds pretty straightforward, right? If this was the actual path that you were supposed to take in order to achieve profitability, well then that would be pretty straightforward. But unfortunately, right, for most people, this is not the best route. I'm not saying it can't work, right? Many people have copied and pasted someone else's strategy and found success with it. But in the next few minutes, I'm going to explain exactly why that's probably not the case for you. So again, the path that most people take is this one, and 9 times out of 10, that is going to fail. And there's one specific reason for that. You see, me and you, we have a brain, at least I hope, right? This is my brain, and let's say that this over here is your brain. Surface level, these two look identical, right? I mean, there's pretty much nothing different about them. If we open up our skull and we take out our brain, they look the exact same. But what goes on inside brain A might be entirely different from what goes on inside brain B. And whether you believe this or not, right, whether you believe this is accurate or not, a trading strategy is heavily dependent on your individual response to certain things. So in other words, every single brain has the exact same structure, right? But they have different responses. So, for example, if brain A, right, he takes a losing trade, this brain up here, which is my brain, might interpret that loss as positive, right? So that's a plus. Whereas brain B might endure that exact same loss and his brain will take that as a negative, right? And so the exact same scenario, but 2 different responses. Why? Because no brain is identical. Why do you think we have psychopaths, right? If every brain operated the exact same way, well, then there would either be, the world would either be, full of psychopaths, or we would have no psychopaths at all. And that's just not the case. And so what I need you to understand is A strategy might work for me, right, here in brain A, because my brain interprets that strategy different than yours. So the exact same strategy can be applied by me and you, right? Trader B, that's you, and mine can come out on top, right? Whereas yours comes out negative, even though we trade the exact same thing. Why? Well, again, because our brain gives a different response. And so trading is not just copy and paste profitability. That does not work for 99% of people. And so how do we do it? Well, the way to combat this is to craft systems based on your individual data. And I know, I am not trying to be this classic trading influencer that's going to tell you, you have to collect data, blah, blah, blah. But listen, you've heard this before, and chances are you haven't really listened. Take it from me, okay? I'm not here to do anything. I'm not here to sell you anything. I'm not here to do anything. Data is the single most important decision that you can make within your career, okay? It is the only way that you're going to achieve the goals that you want. And I was, doing the exact same thing as 99% of you out there. I didn't care about data. Why? Because it was, repetitive. It was boring. I didn't think that it actually mattered because there was no instant reward. But as I got more mature and as I traded longer and longer, I realized that my data is the only reason why I'm able to consistently pull money out of the markets. I've essentially turned my life into a permanent money printing machine, and I was only able to do that through my own data. So I'm going to explain exactly what I mean here. Okay, so this is the path that most people who end up, becoming profitable actually take. So number one, right? Trade different systems. This is unavoidable. This is something we all go through, right? In the beginning of our career, we jump systems as if we're changing our underwear. And that is simply because we don't understand that profitability has very little to do with the system that you trade. You see, there's one saying I always refer back to, right? I've taught literally thousands of people how to do this for a living, and this is the first thing I tell every single client that I've ever worked with. The system does not define the profitable trader. The profitable trader defines the profitable system. That is something you guys have to keep in mind, okay? The system is not going to turn you profitable. You turn the system profitable, not the other way around. What we then have to do is collect endless data. And why is this arguably the most important point of this entire roadmap? Well, it's the most important part of this entire roadmap because this is exactly and only what allows you to figure out exactly what mistakes you're making. And don't be one of those guys that sits out there, thinking that I don't make any mistakes. The market is pretty much against me. No, buddy, you make endless mistakes. The reason why you don't think you make mistakes is because you don't look at the data that's literally telling you, hey, this is your mistake. Listen, I want you to think about it like this. Data, right? Data costs money. Why does data cost money? Because data is information. Right? And in life, we have to pay for information, right? It's simply part of life. Whenever you pay for a college degree, whenever you pay for a course, if you have private lessons, whatever it might be, information is going to cost you money in any given industry. And trading is no different. Most people have, taught you that trading has absolutely zero expenses, but that is not accurate. Our expenses is the losses that we take because we need those losses in order to figure out what we're doing wrong so that we can improve and eventually make money consistently. So our cost of doing business is losses. So the next time you endure a loss, how about you tell yourself, okay, well, this was simply the cost of doing business, much like any other business. Now, collecting the data on its own is pretty much useless, right? You also have to review it. This is also something I've seen with countless of people that I've worked with. They have hundreds of pages of data, but when I ask them, okay, so what does the data actually tell you? They can't give me an answer. Why? Because they haven't even looked at the data they've spent time collecting. Collecting this data and writing it down is not going to do anything. It might build a little bit of discipline, but it's not going to help you push, yourself towards whatever goal it is that you have. So collecting data is important, but what's even more important is reviewing that data, right? Because you have to figure out what you're doing wrong, and you figure that out by reviewing it and comparing it. Then what you'll typically find is, a list of a few things that you might do wrong, right? A consistent pattern that seems to appear within your losses. And what you do after that is you move straight to step number 4, which is to refine your system based on the data that you have just looked at. What's even more important here is that you continue to backtest your statistical ROI, okay? So what I mean here is simple. You have a system, right? Some people tell you you should backtest for hours on end for years. Listen, gentlemen, I backtested probably the first year of my trading career, and ever since then, I've barely backtested anything. And I'll tell you exactly why that is. It does not take me very long to figure out whether a system is profitable. All I have to do is backtest that system throughout, let's say, the last 5 or 10 years, figure out on average what the, annual ROI of this strategy is, and then you trade it. If it's profitable at the end of the year and it gives you a return that you're comfortable with, well, then again, you trade it. It's really that simple. And if your system suddenly stops working, well, then you'll notice. Why? Because you'll suddenly start losing a lot more than you'll win. And later in this video, you'll figure out exactly why strategies can actually go from profitable to unprofitable. It is not always the trader's fault. The second last step towards profitability is, in my opinion, one of the most important ones, and that is to understand probabilities. Now, you've heard this before, right? Why is it important to understand probabilities? Well, it's important to understand probabilities because that is quite literally what you're doing on a daily basis. It is what you're trading. You see, gentlemen, the market is random, right? If we have a market and you had to bet money on it, right? You had to bet money on that market going up, down, or moving sideways. It would be entirely random whether you would win money or not. Nobody can predict with accuracy whether the market goes up, whether the market goes down, or whether the market is consolidating. In other words, the markets are random, whether you like to hear that or not. The reason why we're able to capitalize in a market that's random is because we are trading a statistical system that is based on probabilities. So all we have to do is make sure that we are on the right side of the probabilities. But in order to do that, we have to understand probabilities as a whole. So what does probabilities mean? Well, in my opinion, I explained it like this. We have certainties, right? And then we have probabilities, right? So certainties, which is up here, is when something is guaranteed. And if I were to ask you right now, is you winning your next trade guaranteed? You would probably, hopefully, say no. And so if it isn't certain, well, then it's a probability. And what this means is you should never focus on, the next trade or one trade at a time. What you should do is focus on the next series of trades, right? Because those are exactly what matter. Not one trade, not two trades, but maybe 20. The next 20 trades is what matters. The next handful of trades, they don't matter at all in the, grand scheme of things. And once you understand that, you are able to turn losses from a negative into a positive because it is simply part of probabilities. And at last, you repeat this process until it becomes second nature to the point where you are able to finally consistently pull money out of the market. In other words, trade different systems, lose consistently, repeat this for years, get so tired to the point where you have to figure something out or you're going to give up. You look into your data, you find your weaknesses, and then you repeat this process until money comes out of your computer. This is, in the most simple form, how you become a profitable trader, and I speak from experience. Now, here were my two problems, because you're probably out there wondering, well, okay, you did all this. What were the issues that you were facing? Because maybe you're facing the exact same problem. So the first problem that I noticed, and the primary issue that I had, was the fact that I always lost whenever the market was trading one-sided. You see, the market can do one of two things. It can either go up or down, right? So an uptrend or downtrend, or it can be a ranging market. In other words, a consolidation where price goes like this, right? Those are the two markets that we have. Either the market goes up, down, or sideways. There's really no in between, right? So it's either trending or not trending. Now, my issue, and this is actually an issue that is less common, was the fact that I would nearly always perform very, very well whenever I was trading within ranging markets. So I noticed that, I had about a 70% win rate, during a good month whenever the market was ranging. But whenever we had a uptrending or downtrending market, well, then that same 70% win rate now dropped all the way down towards 35%. And so that was my issue. Whenever the market was very one-sided, I tend to lose money. And I didn't just lose a little bit of money. I lost so much money. And that was my problem because, believe it or not, most of the time a market is, going up or down. And whenever that was happening, I was losing money. And so you might sit there and say, well, the solution here is quite simple. Right? Just avoid this and only trade this. And yeah, that works. But the problem is a market is uptrending and downtrending a whole lot more than it's consolidating. And of course, I don't want to be limited by my strategy. So, okay, if we now, have an uptrend for 8 months straight, I can't profit at all. That's not, I was not willing to do any of that. So I had to come up with a solution. But before I tell you that, I noticed another pattern. Whenever the market was trading to the upside or the downside, I tend to lose more money than I was making whenever the market was ranging. And so that was another problem within itself, because I was overall negative because I was losing money more than I was winning money. And it was that discovery that indirectly created my most profitable system. And what I'm going to do now is show you that system, okay? But before we do that, I want to show you that the trade I'm about to break down was actually a trade that I ended up taking. So unfortunately, I had some sizing issues and it only resulted in a profit of $1,700, which to a lot of people is a lot of money. This is another trade. That's not the one we're going to focus on now. And for transparency reasons, I'm going to come up here. I'm going to click on demo. You'll see that it says no data found. We're going to switch back into my live account. And there we have those two orders. So the first thing you have to understand about this system is market structure, right? Because the whole problem with this system to begin with was the fact that I had trouble trading trending markets. And the easiest way to fail to trade trending markets is to not understand the direction. So I had to figure out how to read market structure. And I had seen all these traditional classic market structure videos, higher highs, higher lows, blah, 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 blah. That didn't work. So I came up with my own market structure analogy, okay? And that's exactly what we're going to be breaking down now. And it's essentially comparing highs to lows. So for example, this is a downtrending market, right? When you look at it, it's very easy to identify that this is a downtrending market. But let me show you exactly why I know that this is a downtrending market. So the first thing I look at, right, is the reversal point before the downtrend took place. That's the high we're looking at here. Right now, there's one specific thing that I need you to notice here. This high got swept by these two highs here, right? And what happened after these two highs got swept? Nothing, right? We got no follow through above this point, which tells me that buyers can't push price above highs, but sellers can in fact push it below lows. Because if I now compare what happened to the low when we hit that, well, then it's night and day. We got no follow through to the upside, right? But we got massive follow through to the downside. And that tells me that sellers are in control. Now, if we then, do that exact same procedure here, you can see the exact same pattern. We hit the high, nothing happened, right? Now let's look at what happened when we hit the low. Did we get more follow through at the low when compared to the high? Yes, absolutely. And I mean, this literally goes on, right? We can do it again here. The high was hit, right? We got no follow through to the upside. And if we now compare that to the low, well, then you can see again a night and day difference. So this is in very, very simple terms how I determine market structure, right? And I was expecting that exact same thing to continue now. Now, there's one reason why I expected this to continue, because the pattern had just proved itself once more to me. We have a high here, we swept it, and we got no follow through to the upside. And what happened right after that was a massive dump down towards this low, where we certainly saw more follow through when compared to the high. So this here tells me that, okay, sellers are still in control. Now, all I have to do is figure out how I can short this market accurately. And luckily, there's one specific tool that I always use. The problem is most people know about it, but they don't know how to use it. So what we're going to do, if you're on TradingView, you're going to come up here where it says Fibonacci retracement, and then you're going to, apply this exact same setting that I'm going to show you now. So we're going to come in here. These are the settings, okay? We're using two zones, the 0.71 and the 0.79%. The reason for this is incredibly simple, okay? Most people are taught to use this as a reversal tool. So for example, we have an uptrending market here. And whenever this gets a massive reversal and turns into a bear market, you are taught to use the Fibonacci extension tool to time the bottom of that bear market, AKA you're trying to catch a falling knife. So most people draw it from here all the way up to the high. They long it from the first zone, hoping that they're going to catch the entire market reversal, which, in the long run is just not sustainable. What's much easier is to simply follow the existing trend. And I'm about to show you how simple that actually is. So let's actually go to a 1 minute time frame here, or 2 minute time frame, and I'll show you exactly just how accurate this is. Okay. So if I now draw it from this high, right, down to this low, you can see that the pullback ended within these two zones, right? We do the exact same thing from this high down to this low. And unfortunately, this time around, right, the market failed to hit these two zones, but what it did instead is hit the optimal trade entry, which is, the 0.618. So if you don't have these settings, this is also something I use very, very often, right? They're right here. You can pause the video and grab the settings, right? And if we come down here, right, and we draw it from this pullback, right, a very small one, you can see that exact same thing. If I now switch this to the 71%, you can see that we literally just tapped it and then we crashed. And so the pattern is clear. If you want to time pullbacks within a trending market, you use one of those 3 zones, but preferably for the highest accuracy, you use these 2. Right? But the most important part about this entire system is that you learn how to identify market structure using the exact same analogy that I just taught you. And so because this had happened, multiple times during this bear market, I was essentially, looking to capitalize on that exact same thing. So what did I do? I drew my Fibonacci extension tool from this high all the way down to the low down here. And I was, met with these 2 zones, the 71 and the 79%. I shorted it from the first zone. I kept my stop loss near the high here, right? And then I targeted it, these lows down here. We have equal lows here, we have a low here, and we have one here. This was my exact trade, right? So nearly 3R. And if I play it out, you can see just how well this actually ended up working. And this was the trade that unfortunately I would have, normally made a lot more money on, but I only ended up making, $1,700 because I accidentally clicked, a few buttons wrong. But that can happen. What I do in a scenario like this where I could have made, I should have made more money than I did, well, then I simply write it down to make sure it never happens again. But there's one more part of this strategy, okay? And that is having a target. So I wasn't just expecting the market to go lower for no reason. No. What we had, actually, this is the wrong time frame. Let's go to 12-hour time frame. What we had was a massive 12-hour fair value gap, which is exactly what you're looking at here. Right? The market does one of 2 things, and I'm going to write it down so you remember. It either seeks liquidity, which in other words are, highs or lows, or it fills imbalances, okay? And you might wonder, what is an imbalance? It's a 3 candlestick pattern, okay? And it goes like this. This, the bottom candle's wick, the top of the bottom candle is here, right? The top candle's bottom wick is here. The space in between these 2 wicks is your imbalance. And if I now zoom out here, right, notice literally every single gap that was created, right? So we have one here, that was hit. We have another one here, that was hit. We have one here, that was hit. We have a very small one up here, that was hit, a bigger one here. In other words, right, these get hit 9 times out of 10. So when we have such a high or high time frame imbalance, right, this is a 12-hour time frame, this is a rather large imbalance, well then chances are we are going to hit that imbalance. And especially given the fact that the market had just swept the range high. Right, so I was pretty much waiting for a pullback into this imbalance here because we had just swept the range high. Again, we got no follow through, and I was expecting a rotation from external highs, which is this one, right, into internal liquidity, which is the imbalance you're looking at here. And so instead of waiting for that to come all the way down here so that I could long the market, I instead just capitalized on the market short down towards that imbalance because I knew it was going there anyway. And so, gentlemen, that is the entire system. Now, there's one more thing that is crucial to my success that I want each and every one of you to understand. The last and probably most crucial mistake that I found whenever I analyzed my data was the fact that my losing days, tended to outweigh my winning days. So whenever I had a green day and whenever I had a losing day, my losing day was typically larger than my green day. So even though at certain times on paper, I was supposed to be profitable because I was in profit when you look at risk to reward, but when you look at the actual dollar amount, I was negative and I had to find a way to combat this. And I came up with this bright idea. You see, the problem was whenever I had a winning trade at the beginning of the day, I had no problem in telling myself, okay, I'm going to call it a day here. I'm going to go do whatever I want because I've made money, right? That was no issue. But the opposite happened whenever I started off with a losing day. It was very difficult for me to turn off my system and walk away, which means my losing days oftentimes turned into, massive losing days because I simply could not shut off my system and wait for tomorrow. So I had to do something, and this is something that I've recommended to everyone, and I will continue to recommend it, and that is trade once per day. Whether that's a break-even trade, a winner, or a loser, you call it a day after you've hit buy or sell. Not only, if you have a positive risk-to-reward ratio, does that ensure that your winning days, it's literally impossible not for your winning days to become bigger than your losing days, but it also immediately kills any chance of overtrading, any chance of any emotional mistakes happening. And so as a trader, you have little to no control of what's actually going on, right? Earlier in this video, we established that the markets are random. If they weren't random, well, then this would be a game of certainty, not a game of probabilities. So you don't even control whether the market goes up, down, or sideways. You don't control whether you win or lose. You literally control nearly nothing. You control where you enter, you exit, and the amount of risk that you put on before you decide to place a trade. And so the things that you can focus on, you better focus on. And when you have the ability to remove any chance of any emotional mistakes taking place, well, then you better exercise that ability. The problem is, it's not just as simple as, I'm going to trade once per day, that's it. No, because it's a question of discipline. And so if you're out there watching this video and you consider yourself a disciplined individual, well, then I challenge you to try and trade one time per day for the rest of this year. If you can complete that, well, then I can almost guarantee you that your trading results at the end of 2026 are going to look significantly different than they did in 2025. And I also promised you I would show you why most people never show their entire system on YouTube, me included. What I showed you here was an outline of my actual system and one example. I'm never going to publicly break down my entire trading strategy for this one reason. Except that's a lie. I have a private community where I have broken down my entire system, but that's because I know so few people are going to join that what you're about to learn here is not an issue. You see, what we're talking about here is something called alpha decay, which a lot of people out there probably haven't heard about. And to basically sum down this entire study, right, there was a specific trading strategy that returned approximately 10% annually in the 1990s. But today, that figure is closer to 8%, right? So it's nearly 80% worse. So what happened? Well, a growing body of evidence documented the decay of factor premia following academic publication. That means this strategy, right, before it went public for academic use, well, then it was returning on average 10% annually. After universities and whatnot started to use this strategy academically, meaning a lot of people were exposed to this strategy, well, then that annual return dropped from 10% all the way down to just 2%. And so whenever you see a person that's out there, trying to sell you the dream, most likely they're not trading that strategy themselves. And if they are, well, then they're probably unprofitable. Ladies and gentlemen, if you're interested in joining my private community, we would love to have you. And the value you get for the small amount of money you pay is ridiculous. So check out the link down below. And without further ado, I really hope you enjoyed this video and I will see you in the next one.